So starting with kind of defining those uptrends, downtrends, and sideways, or otherwise known as a no trend environment, we're going to be looking for periods of successive peaks, successively higher peaks and troughs. And this is the signature of an uptrend. It doesn't have to be any more difficult than that. I think if you were to look at a chart and then have maybe a child even take a look at that chart. And this is based on analogy that a former colleague used to use as an example, where his son would be looking at charts and he would say, is this an uptrend or a downtrend? And even a child with no knowledge of technical analysis, at least based on kind of the Western or American style way of reading, which is from kind of left to right here, as we see price go from left to right upward, it's an uptrend. If we see price from left to right go down, well, it's a lower point, it's a downtrend. Now we can be a little bit more, I guess we could say, particular with that. In the case of uptrends and downtrends, we want to look for higher highs and higher lows for uptrends and lower highs and lower lows for downtrends. Sideways trend is exactly what it sounds like, right? No clear price direction either up or down, hence the sideways fashion. So when it comes to trading, such a kind of trend here, if you're looking at an uptrend, right, it would make sense to use like bullish strategies. And right, nothing earth-shattering here, but it has to be said, far too often folks are putting bullish strategies on stocks that aren't trending upward. How many here found themselves putting maybe covered calls, and I say this because I see this a lot, covered calls on stocks that are trending downwards, because they'll tell me, oh, the stock is going down. I can sell a call. I'm going to make money on the call. But you're losing money on the stock and it's not being profitable in the long run for you. You're blinded by those profits on the calls and ignoring the losses on the stock. Jim, I saw your hand pop up there. And yes, and I do have the anticipation to talk about at least some of those strategies later as well. But that should be at the forefront of your mind, right? That price outlook and the strategy. If it's a bullish, if you're looking at an uptrend and you're expecting that uptrend to continue, you should be looking at bullish strategies. If you're looking at a downtrend and or you expect that downtrend to continue, we want to be then putting on bearish strategies. Sideways strategies, sideways kind of trends, or no trending environments, oftentimes are going to favor income strategies. Those are those kind of credit strategies. And you could put a little bit of a bullishness or bearishness in them because most strategies have a little bit of a bullish or kind of bearish tilt to them. But ultimately, you're using the passing of time now to your advantage when we're presented with sideways strategies. Now, those kind of uptrends, downtrends, and sideways trends, we can use our own tools within Active Trader Pro to help kind of establish when we're looking at an uptrend and a downtrend and a sideways trend. Trend lines are something that can be a little bit intimidating for some folks at first because it really puts your own kind of creativity in your own hands, where you're going to have to draw and you're going to have to commit to what you're drawing and going with what you're using. But starting with trend lines to connect those reversal points that you see can help you just define those uptrends and downtrends within a given chart that you are looking for. And those trend lines are fantastic because they're not used to predict the future. All because we draw a trend line that's going upwards doesn't mean the trend is going to continue, but that can help kind of create the framework that you can use to help ensure whether you are sticking in line, you're putting on your trades, it's staying in line to what you're seeing on the chart. I know it's sometimes tough to put on a strategy. We're charting something that maybe could be contradictory to what our ultimate strategy is, but making sure your strategy also is aligning with what you're seeing on the chart. Simple, but it's something that can help you. Now, sideways trends, also known as kind of areas of support and resistance, are key for quite a few strategies. And we'll talk about that when we jump, of course, to the demo. But what is support and resistance? On the slide here, it says it's supposed to be a horizontal line drawn. That's actually not the case. There is horizontal support and resistance, and there's diagonal support and resistance. The diagonal support and resistance is what you can find when looking at uptrends and downtrends. But what's occurring at these kind of support and resistance kind of levels, not exact prices, but levels, that's an interaction or I like to use the term kind of battle between buyers and sellers, also known as supply and demand. At areas of support, that is where enough buyers are coming together, thinking to themselves that this is a good price. This is where I'm comfortable at least owning shares of that stock or ETF. And inversely, the resistance level is the point on a chart where traders are saying to themselves, we're getting a little bit extended here. This is going to be the time to either take my profits or lower my equity in the position. So that is meant to at least just add a little bit of kind of backstory to support and resistance. And when it comes to kind of using support and resistance for options trades, they could be kind of areas where you might decide to put your strike prices. This could be the areas that you're going to wait to either enter or exit a trade. And support and resistance can be very key for options traders, both for buyers and sellers, both for traders that are looking for income versus traders that are looking to take advantage of the leveraging ability. Because we're basing our decisions on areas of supply and demand that we can see, right? We can see how this has occurred multiple times in the past, and it somewhat adds a little bit more kind of objectiveness to our very subjective take on what is happening on the chart. We want to find as much concrete, facts, truth in our chart when we know it's always going to be based on our own perception. So support and resistance is absolutely going to be kind of key here. So, Jason, I think we could go through maybe a little more slides within the chart. Anything you wanted to add on support and resistance, or at least a little few more slides before we jump into charting with Active Trader Pro, or any other kind of concepts that you want to cover before the demo piece?
Yeah, let's hop into just a few more slides. We'll keep it pretty brief here. I think some of them we're going to talk about what we're going to demo here shortly anyways when it comes to moving averages. What I would just note is when it comes to support and resistance, keep in mind that we often teach it from a horizontal perspective, but we can still look at it from an angle or a diagonal perspective as well. Very, very common to do so. These slides I'm rolling through, they're just talking about what a simple moving average is, how it's calculated. For anyone who wants to go through that more detail, let me know if you have a specific question on the calculation, but we're going to talk about them here in just a moment in a demo. So I'm going to quickly roll through these and talk about this last portion of our slides, and we'll hop right in. So this is the breakout conversation. I think this is important for a lot of traders because we talk about support and resistance. We talk about patterns. We'll talk about a trend, for example. But I don't want to say it's meaningless, but what we're waiting for in the identification of a trend or in the identification of a pattern or some kind of diagonal or horizontal support resistance is a meaningful breakout that then tells us, okay, we're now in this new supply and demand relationship, right? Oftentimes, and I've been a victim of this myself, you see a pattern forming, you say, all right, I'm going to enter in before the breakout because you want to get in early, only for the breakout to be in maybe the opposite direction, and you didn't wait for confirmation. So I think the idea here when it comes to breakout is simply we could almost change this and say confirmation, right? Like waiting for some kind of additional confirmation. Typically, we talk about that from a price breakout perspective, but the confirmation is really the big point there. What would be an example of a breakout? This slide showing it here. So if a price is coming up and into resistance, then we have some kind of throwback lower, then a pullback higher, right up into that resistance level once again. This is that critical moment of to say, all right, are the bulls going to outbid? Are they going to beat? Are they going to defeat the bears and take over? Are we going to enter into a new regime, if you will, of trend? And if it fails, then you kind of have your answer in the short term. Nope. The bears are still in control at this level. Supply is still numerous. But if you get the breakout, that's that intermediate or maybe even short-term confirmation, depending on a chart you're looking at, of, okay, somebody is now in control that at one point was not at that given price point. So yeah, breakouts are going to be important as we talk about some of these examples on these charts. Specifically to options trading, I think this is kind of interesting here. So why would it matter? Well, because you might be in a previously bearish type of, let's say, trend that finally breaks out and outside of a simple moving average, 5-day, 20-day, 50-day, whatever it might be. And that could indicate to you that you're now leading into a bullish new environment. And the sooner that we can determine that, we may want to enter into a bullish strategy, right? But if we get a breakdown, that's going to indicate, well, maybe the bears are in control. So those are the things I wanted to cover and just add to your conversation there, James, when it comes to support and resistance, breakouts or confirmation or sort of the finality, if you will, of those moves is definitely going to be critical as we think about this. Now, I would also point out if you're an options trader, this is probably more critical so than to a stock trader because you have expiration to worry about, right? You can't wait and wait and wait and wait forever for the breakout necessarily, depending on your expiration selection. A stock trader might be able to hold that stock or ETF indefinitely, right? As long as it doesn't go bankrupt or get delisted. So that timing aspect is going to be very, very important. James, I'm just looking through our Q&A real quickly before we hop into the demo. A few symbols that came through, two from Christine, another one from someone going by Anonymous. John was also making a comment about maybe strike selection, so I'll acknowledge that there too. We had a former question that came through about average to range, so we can talk about that. And then Joy's giving us some feedback about some previous slides, so that's definitely good to see. So what I would like to do at this point, and James, let me know as well if you already have an example slated. I would love to pull up a few different stock symbols and maybe put this narrative or weave this story together and talk about maybe what are a few ways that us on the trading strategy desk might look at this, putting technical and options trading together. So I'll start us off. I'll keep it super basic, James, and I'll pass it to you. I know that you maybe have a couple of examples set up here as well. So all right, enough talk. Let's hop into ATP. For anyone who's following along at home, we welcome that. And if you don't have ATP, you can go to fidelity.com/ATP to download it. It's completely free. So no problem there whatsoever. One of the symbols that came through, this is from Anonymous, is APA. Now, I wanted to pull this up only because I don't chart it very often. Not me personally, James. I don't recall seeing you pull this up on a chart in a different session. So I wanted some fresh eyes on this, maybe walk through this together as a class. So let's kind of take a step back. What are we starting with here? Well, this is a daily chart. This is important to note. We're on a 2-year time frame. That's how much data we have, but it's a daily frequency. So all these candlesticks are for each individual day. Okay, got it. Next, we've got a slew and a variety of moving average indicators, right? These are all SMAs, simple moving averages. So we've got the black 5-day, we've got the red 20-day, the blue 50, and a green 200. Why do I have these? Well, we talked about it right at the very beginning. We have to identify trend. In fact, James, if I go back to scrolling through on the slides here, just give me one moment. I think, Joyce, this might have been the slide that you were talking about as well. So let me go back here. There's a reason that out of all these facets of technical analysis we can look at, trend is number one. Because if we don't understand the direction of the trend, we really can't position ourselves appropriately for a trade, right? I think about this all the time where we talk about using an analogy of a vehicle. If someone says, hey, the vehicle is moving quickly, okay, cool. But is it moving quickly in reverse or forwards? If someone says, hey, you're going 30 miles an hour, well, if you're going forward that fast or that at that speed, that's not that fast, right? Most roadways are 30, 35, 45, whatever it might be. But 30 miles an hour in reverse is like pretty quick, right? I never go that fast in reverse. So that's a meaningful difference. And the only thing that we've changed in that scenario is the direction. So yeah, speed and the rate of change is important, but more importantly is the direction itself. That's why we start with trend. Now, whether you use support and resistance and moving averages at spot 2 or 3, again, you can start to debate it. But what's not debatable from a technical analysis perspective is trend is first and foremost. Sort of the forefather and creator Charles Dow, yes, D Dow, heavily believed identifying trend is the first thing a trader should do. So primary, secondary, or intermediate term trends, all those kinds of things, he's focusing on trend. So that's why I have the moving averages on this chart as an example, is to help define for us a variety of different trends. The 5 days are short, 20, 50 is kind of the shorter to intermediate term, 200s longer term. So I'll ask the audience, on a 2-year daily chart, what do we think? What do we show? What can we see in terms of trend? Are we in an uptrend, downtrend, or sideways trend? And I would love for the audience to participate. Let me know. And in your response, if you can, maybe define for me which trend. Like, are we saying overall it's a downtrend? Are we saying in a short term? Like, which trend are maybe you looking at as a trader? Because this gets to a very, very important point, which is this, James. From a long-term perspective, we're in a downtrend, aren't we? Because the downtrend line, the 200-day moving average, which I am using as a definition or as a proxy of long-term trend, is pointing downwards, right? And price is beneath it. But, and I'll go ahead and zoom into a 6-month chart view. From a shorter term perspective, price is now above its 5-day, and intraday we're above the 20, although we have not closed above it. So long-term bear, short to maybe intermediate, I still call the 20-day shorter term. Just the 5 days much more shorter term, bullish. And so that we have to start weaving this narrative together and say, okay, well, short-term bull, intermediate term bear, long-term bear. And if you think about this from like a points system perspective, it's like, all right, -1, -1, +1, +1. So, we can think about it and say, well, from a weight of the evidence approach, just from these 4 moving averages, it's kind of split, right? What else can we do? Well, we can look at momentum. What is momentum showing us? Well, a bunch of red, right? The rate of change is not, the direction is not only in reverse overall, but there's some gas on that gas pedal going backwards, right? We see a lot of red here. Okay, what are some other things? We mentioned ATR. James, I'll save that for you. I know you have an example to talk about ATR, but we can add that as a technical indicator. So my point is, I'm trying to keep this brief, not doing the best job there, but is we can start to use some of these indicators to start and then use that to hop into our options trade. So if we look at this chart, let's zoom back out to a 2-year perspective. A few things that stand out to me, in fact, I'll go back to a 1-year for just a moment here, James, is I did note this area of price action, which is making lower highs and lower lows. Then it started to flatten out a bit, and then it launched higher. Excuse me, I'm trying not to sneeze here. My apologies. But we can see momentum doing what? Well, it's making a divergence. As price was going lower, momentum was going slightly higher, right? So what's happening here? Well, price is meandering lower and lower. And just recently it started to make a little bit of a comeback. And what are we seeing with price? Not quite as clear of a divergence, but still a bit of a divergence over that similar-ish time frame. So again, are we predicting that this next leg has to curl and launch up higher just like it did before? No. But could we forecast that? Would that be warranted based on some of the technicals? Potentially, right? We could definitely say, hey, over this period of a couple weeks to a month or so, probably 2 months, there's a divergence. And here's the next one. Now you could say, oh, Chase, well, it kind of broke beneath it. It did, for sure. It's not exactly the same. Is it similar? Does it rhyme? Maybe not repeat? Potentially, right? So if our forecast is to say, okay, well, The last time we broke up and above the 20 and a 5 with maybe a few days of confirmation, we rallied up whatever the number is, 17%, let's say. So what am I expecting from a technical analysis? Again, keep it as kind of simple. Maybe something like this, right? Another rally. If that's the case, then we hop into the option chain as an options trader and say, well, what would make sense at that point, right? We could take a look. We'll put in APA. How long would this take? Well, the last time it took about, let's see, we'll say about 2 weeks worth of time minimum. But if I buy a 2-week option, then I've got no time in my budget, right? I've got no leftover in case I'm wrong for a day or two. So maybe I want to budget in a little bit more time. Well, this closest monthly is 25 days. That's a little bit longer than 2 weeks. If I want to go one further out, that's August. That should be extra time. I'm going to have to pay for it. And there's going to be some kind of earnings premium likely associated in part to this. But again, keeping it kind of high level here. Let's just say we go with this expiration. Next is our strike selection. Well, what strike kind of makes sense if we're looking to go bullish? Well, the projection, the forecast might be around like the 34, 35 level if we get the same kind of run that we got the last time. All right, so where's the 35s? Right about here. What are they going for? Actually, not a whole lot, 17 by 20 cents. So very, very cheap from a nominal perspective. Okay, if we were then to move forward in our analysis, we go to the options, analytics, and then the profit and loss calculator. And lastly, in here, and I'll pass over to you, James, to hop in more into detail with your example. We could mock it up and say, hey, what if I bought not just one, but what if I was looking to get maybe 10 of these? What would this look like for my trade moving forward? Well, if what I expect to have happen happens, and let's say stock moves up to $34 per share in, 2-ish weeks worth of time, let's say, what does that look like for me? Well, I'll cross-reference the 7/12. That's the about 2-ish weeks, right? I'm kind of going through this a little bit lax. At the $34 per share, we'd roughly make about $839. But our cost, our basis, our investment, if executed at the ask, is $200. So that's you can kind of put it like a 4-to-1 reward to risk ratio, right? That's not bad. But what if we're wrong? Well, if we're wrong, then we'll lose the $200 at worst case scenario. So if I kind of step back from this example, I know I'm working through it a little bit quickly here, but the idea is that we can start to take these technicals, appreciate the current environment that we're in. I see a bunch of comments that came through, right? So if I read through these, Joy says downtrend. Myro says downtrend. Christine, downtrend. China, overall downtrend. Steven says, in my opinion only, dead cat bounce. Let's see. Joy says overall price is below 200. Paul says long-term downtrend. Going through, Myra says short, intermediate, and long. And then, yeah, most recently we've got another comment here that says, hey, long-term downtrend, but short-term uptrend. And so that's the whole point, right? We're trying to get this evidence and say, is this worth my options investment or an investment of my dollars into an options trade? Maybe better said. Now, I was just talking to a client, James, one-on-one before the session. We were talking about how, unlike our legal system, these investments should be guilty until proven innocent. In other words, they should not garner our cash. They are not worthy until there's enough evidence to prove it to us, right? So if you're looking to be a bullish trader, does this have enough indication from a technical perspective to buy a bunch of long calls or to sell a bunch of puts? Well, in the long term, short answer is probably not, right? It's bearish. Why would we have a bullish trade on a bearish setup? But if you're a shorter term trader or you're a longer term trader looking at the shorter term changes, maybe you start to put on the position, but if you keep it really small, maybe you just leg into it as opposed to your full position of 10 calls. Maybe you just buy 1 or 2, wait for this to develop. But that's just kind of a quick example of how you can start to use these technicals to then hop into or build up that type of option thesis and looking at the option chain and matching your expiration to different technical forecasts. I'll pause here for just a moment, James. I know you're getting your example together specifically to what I've shown here. Any other kind of comments that come to mind, things that you want me to maybe add to this? I'm happy to look at some other indicators as well, but just curious on your thoughts so far.
No, I definitely want to show. I think it was John mentioned talking about ATR, and I kind of referred earlier to the way that we can use, many of these indicators, right? Especially trend indicators, possible momentum indicators to help us with the price direction and time outlook. But when it comes to our volatility outlook, they really can't be used in a similar kind of fashion, so to speak. So I've got my Active Trader Pro trying to get pulled up here. Give me a second if I can hopefully get this to load. But what I could do is at least start with showing Chartplus, which I'm a big fan of using. And for this example, I wanted to pick a stock that had moved kind of quite a bit in the near term and had quite a bit of kind of volatility, especially a big name stock. So let me go ahead and share Apple here. And actually, Chase, if possible, since you still got the screen, mine's
Yeah,
still
let
not
me
really
know.
working. Could you just pull up a blank kind of maybe a 6 month chart on Apple and load ATR? And I'll kind of explain what I was going to refer here.
Yeah, let's do it up.
And so what ATR is doing, it's just an indicator, right, that can help us with kind of measuring just the volatility of an underlying. So in this case, we've got ATR and ATRP. Noticing the lines are kind of more or less, right, they're doing the same thing. It's just a different calculation. One being a calculation that's going to show us it on price, and another based on just doing it by a percentage. So the either of them, it's not going to matter what those digits are, but I want to compare. So Chase, just remove either one of them, just ATRP or ATR, and add an indicator for implied volatility. So if we go up to indicators and I usually type in IV, one of the indicators is volatility HVs and IVs. And if you can, I know this is sometimes problematic here, but just remove the historical volatility and just keep it so we're just looking at implied. And what I want everyone to kind of see here is that these lines, right, they're not exact, right? They're not kind of mirroring each other. And especially that recent move up in Apple, right? Due to this would have been, what was that? Just about a week and a half ago. Notice how the ATR kind of shoots upward, right? It's capturing that very large series of intraday movements. What does the implied volatility 30 do? Okay, it goes up, right? But it's not really staying elevated, where ATR, and this is even a kind of a fantastic example also, where we've got examples where it's moving up quite a bit, stays elevated, and what does implied volatility do? Well, nothing, right? It remains somewhat constant. And what happens when we maybe get an earnings movement that again shows kind of ATR spiking, but implied volatility moving down? And that is going to be key, right? For a volatility trader when it comes to options. When we talk about volatility as an options trader, it's different than what a stock trader might be referring to as volatility. So a volatility indicator like ATR doesn't, I'm not trying to say it can't help you for you options traders. It still helps us get an understanding of when movements were very kind of relatively larger or greater than what the average move would have been, ATR, average true range, so we can see when those kind of ranges exceeded their average, but it's not helping someone kind of really take advantage of changes in volatility. So I just wanted to kind of bring that up, especially for those of you that have used volatility indicators in the past. But kind of looking at this, let's go ahead and now kind of look at on the chart. And Chase, I'll try to kind of take it back here. If my active trader pro, I'm trying one
So
more
James,
time.
while you're trying to do that on the back end, let me just clarify for folks while you were talking. I know my mouse is moving all over the place, adding some of these lines here. So I want to clarify. So I'm just trying to create a vertical line to indicate time on price, average true range, and then the IV30, just so you can kind of more easily associate a specific event across all three portions of the chart. So just to build on what James was saying here is earnings can be a massive catalyst for price action, right? So we see price gap up higher, big movement that's shown in the average true range of price itself. Average true range is just measuring historical volatility of price itself of the underlying, in this case, Apple, right? So if the line's going up, that means there's been more volatility. Same thing over here, right? Big green bar. I think our teammate Robert Kwan would call us a big green lightsaber, right? Just a big beam here. And we see that being added to the calculation, indicating an increase in historical volatility. But the point that James was making, just to build upon why I have all these lines, is at the same time that historical volatility or the stock price itself is being more volatile, the options market is actually having a decrease in implied future volatility here. See that giant drop off, that almost waterfall effect? I hope that's coming clearly through for everybody. We often refer to that as volatility crush. So if you're an options trader, this whole concept of volatility, aka implied volatility, the mathematical demand of options, is unique. It doesn't exist in the stock land, right? You just buy or sell stock. But let's say you had a long call expecting things to go higher, things being Apple stock price to be a bit more precise. So Apple stock goes up. Okay, that's good because you have a bullish position. But all things being equal, your option at the same time will be adjusted for the decrease in demand of the option because implied volatility is falling through the roof, right? Or probably I should say it's falling through the basement here in this case. So the idea is that our option price is simultaneously taking in all these different inputs for its valuation. And I'll ask this question. Has anyone been right on an earnings call and lost money on an option? I raised my hand because I definitely have, right? I've purchased a long call for a stock thinking it's going to go up. Earnings come out, the stock goes up, and I lost money on the trade. That does happen. And people think that it's the options market's rigged. It's the market makers. I mean, while that could be a small factor in very unique instances, really it's the market dynamic of that implied volatility in which the demand for your option has plummeted after a significant binary catalyst like earnings, right? And then James, to your point, during this increase of, again, real volatility, as opposed to a sheer drop off, it just doesn't really change at all. So this fluctuation in implied volatility or the mathematical demand for your option will drastically change the value of your option. In fact, let me do this, James. I know did you get your example squared away of behind the scenes? And if you didn't, I'm going to hop further into this one here.
No, I think I have it all set here.
You
We'll
do?
give it a go
Okay. All
on
right.
my
I'll put a
side.
pause on what I was going to say. Oh, back over to you then.
Well, because I wanted to continue kind of showing Apple and even talking about possibly kind of a few ways that traders would use what they saw with kind of Apple's movement, especially as of late. Now, for you folks that have been in quite a few of our sessions for some time, right, you're familiar with up until recently, Apple was presented with a fairly strong level of resistance, right? Going back to support and resistance. And we can see it here. So I'm going to take us back in time just momentarily. And I'll add maybe one more day. So we can see both once, two times, maybe you want to give it a third, and here we are right back at the top. So kind of an options trader in this Apple situation would have some choices. And that is that, right, they don't know what Apple's going to do, what Apple's next move will be. Now, if they were paying attention to certain catalysts, whether that at the money in this case, 210, call. So let's say we got and just to make our numbers even, a 20% move. How would the bullish trader and how would that bearish to neutral trader each kind of, I guess we can say, how would they both kind of end up with both gains and or losses? So I'm also going to throw the other example here, keeping it one contract, keeping the same expiration, just using our August, the next month, still buying that same kind of, or in this case, selling that same contract. In this case, looks like it's being a little bit stuck here. There we go. Perfect. But in this case, maybe selling slightly lower, right, than where we are trading at. Taking in a credit at this point in time. So still buying that same kind of 210 call, which is in some sense the at the money call, which is why we're using it, right? We can see Apple's trading at 210 here. And we can kind of both run through a bit of a scenario. So the trader expecting the breakout, let's say we got that movement, and let's add maybe one more simulated position just for you, the stock traders out there, that they were also expecting maybe a movement to the upside. And they bought right at, say, 210. So looking down below, we've got a few different strategies, and I'm going to remove the Greeks in this session, just focusing on, which seems like a bit of a, I don't know if this is something that no one should do here, but just to focus on price in this case, so we can see our basis and our theoretical profit and loss. So back to that scenario, right? If you were Apple, you were right there at that at the money strike price, which then it was 200, but I'm using at the money contracts just to get a better kind of evaluation of that hypothetical trade. If you were bullish, you could have done two things. You could have bought the stock or bought, say, the at the money call. And let's say we got a 20% movement and that took place in 2 days. So 20% was $20. So let's go from 2010 to 2030. And let's say that did occur in a very similar fashion, just a few days. The IV change, we looked at that earlier. There was a small increase, let's say maybe 5%, 10% increase. I forget the exact number. I didn't look at it, but there was a short increase, even though price went upward. So let's just see the P&L. 1,500 versus $2,000. And what if that bearish trader, and this is why I like the spreads, what if that bearish trader decided to place their spread thinking it would be bearish to neutral? How would they have fared? And in this case, they would have lost about $273. But notice both bullish traders made money. But of course, as a percentage of your capital, $800 to 1,500, right? Almost, not quite, but almost a 100% profit. As opposed to, of course, in this case, the stock trader, well, they made a 10% profit, right? But it was roughly by design. And should things have gone poorly and we dropped maybe 190 points, and maybe we kept IV change and say no IV change. Well, the options trader actually had better risk management, at least from a true dollar perspective, right? We lost 600, almost $700 versus losing 2,000. So what's the difference in the losses? A difference of $1,300 in loss. They're $1,300 ahead. And did you catch that gain? If you're looking at just from a pure dollar perspective, right? There's only a $500 difference. So in this case, if it went in their favor, now we know from a percentage standpoint, right? They can make more money from a percentage standpoint, but also lose more money from a percentage standpoint. But for those looking in dollar figures, well, you're only $500 less profit than if you had bought the stock. And in the loss scenario, you were actually $1,300 less loss. So yes, less gain, but you might say, oh, this is even a significantly less loss. And let's say it went even further down, right? The difference is even greater, maybe a $2,200 less loss on the call, and things went maybe 40 points higher, or we'll say 30 points higher to show the example, which would be 240. And that gain again, it's only a $600 less dollar profit. So this is where those breakout movements that if you're expecting long options, whether it's a long call if you're bullish or long put if you're bearish, can be great with not only reliable or rewarding kind of dollar figure gains and percentage gains, but also losses from a dollar perspective can even be mitigated. And that's that leveraging effect of options that can be used to some extent to also manage risk. And that same trader that was bearish, let's go back to that 10% drop example. Well, that is where you'd be able to make your dollars, right? By selling that, in this case, that neutral strategy, in this case, with a bearish outlook. So I know we're right at time, so I'll stop it there. But we've had some great examples with stocks that both begin with A, right? With Apple, right at that level of resistance breaking out, and another stock with an A, right? Amazon. So maybe that trader that was looking at Apple and thinking to themselves, or maybe looking at Amazon, right? In a very similar case, we've seen a level of resistance established. Maybe they're not expecting the breakout. Of course, the trader that went long call, maybe expecting a breakout on Amazon when we approached it, might not have made money. But that bearish trader, that bearish neutral trader, can use this to make money. And Amazon, not only in this short-term perspective, right? They've been stuck at this level for some time. So already a little bit past time, of course, probably due to some of the ActuTrader Pro issues I ran in, just put us a little bit over time. But hopefully this helps at least just to explain how technical analysis can be used in conjunction with those options traders. Remember, not using technical analysis on an actual options contract. Sure, we could do that, but still on the underlying. But of course, since we are past time and I do want to be respectful, I will stop it there. Hopefully you found the session helpful, right at the very least informative, and that you're going to be better prepared for those future options trades. It's the beginning of a week. We've got quite a few good sessions up in store. So I hope to see many of you then. But until then, please be safe out there. Best of luck on those trades. And I look forward to seeing you. I'm sure Chase does too, in another session later on this week. Until next time, everyone. Thank you, Chase.